How you value a liquor store? Let's find out. Hello, I'm Harry Sidhu, Principal Broker with Mission Peak Brokers. Today we are going to talk about valuing a liquor store business. Accurate liquor store valuations can be a complicated process for business sellers and buyers. It need to be overwhelming or difficult, especially when the seller's financial records are organized and made readily available to the buyer. The liquor store valuation is often a starting point for the parties negotiating. Oftentimes, the business listing price is not the final purchase price. Sellers and buyers ultimately determine the value of a business by agreeing what will be paid, but the price point does not define the business's worth to each party. Worth for a seller may be an expedited disengagement from the business for health or family reasons. Worth for a buyer may be fulfilling a long held goal or developing opportunities for family. The worth placed on the business sale ultimately drives the value. It is very common for sellers to value the business on the higher side, and buyers will value the businesses on the low side. Sellers are often emotionally attached to the business and therefore value it higher. They will add an element to their calculation, such as years of hard work, but sadly for them, sweat equity is not monetizable for business valuations. Buyers, on the other hand, are naturally interested in purchasing the business opportunity on the low end of the value scale, as they assume the responsibility and expenses of operating a going concern. The difference in value bias between liquor store sellers and buyers is why business brokers' valuations are the best starting point for negotiations to the ultimate sales price. Liquor store brokers will vary what type of valuation they perform depending on the circumstances involved with the liquor store sale. The following are the main types of valuation methods used in liquor store valuations. First one is asset valuations. This involves calculating the fair market value of all the assets of a business to determine the appropriate price. This is usually performed when the business is not profitable. Next one is liquidation value. The value of a liquor store assets are calculated as if it were forced to sell all of them in less than a year's time. This is usually indicative of a distressed sale. Next method is multiple of earnings. This is the net income of a business multiplied by a specific multiple derived from comparable sales to determine list price. This method is commonly known as seller's discretionary earnings, SDE. The next one is rules of thumb. The selling price of the other like businesses is used as multiple of cash flow or a percentage of revenue. This is the napkin scratch method. For liquor stores, it is 40% of annual sales plus inventory. Let's talk about sellers' discretionary earnings. Liquor stores are valued primarily on a multiple of earnings. This is a formula known as sellers' discretionary earnings or SDE. Owner's benefit, adjusted earnings, etc. Sellers' discretionary earnings is used by business brokers, lenders, accountants, and appraisers. SDE essentially involves determining the true value of the liquor store's profitability. Once the business profit is determined, it is then multiplied based on comparable sales. The SDE formula uses the business's past 3 to 5 years of financial information to determine the owner's salary, debt service, depreciation, amortization, and excess personal deductions. Okay. The formula assumes that revenue, expenses, and profit remains status quo after the buyer assumes ownership. Calculating the business profits plus the owner's salary and benefits, and then adding back non-cash expenses, and non-recurring expenses. Though no perfect, this methodology has proven itself to be the most effective way to establish the valuation basis of the business. SD formula can be summarized as follows: pre-tax profit plus owner salary plus additional owner perks plus interest plus depreciation. Why is depreciation added back? Depreciation is not an actual cash expense. Instead, it's an accounting approach that permits a business to deduct the purchase of an asset over a period of time known as the asset's useful life. For example, let's say ABC Liquor spends $30,000 on new signage and the accountant determines the useful life is 5 years. Rather than take the deduction for the full $30,000 in the year the asset was purchased, the asset deduction is spread out over 5 years or $60,000 per year. So the depreciation add back is based on the fact that depreciation is a non-cash expense. Next one, why is interest added back? Interest payments are typically unique to the business owner. Not every business carries debt or a particular type of debt for the business. So while business financing is common, it's not standard and based on each business owner's operational approach. Moreover, most business opportunity sales, structured as an asset sale, involves the seller paying off any business-related debt with the sales proceeds. The buyer takes the business unencumbered with the seller's debt. Where a business is sold as a stock sale, the buyer assumes the seller's debt. However, business sales structured as a stock sale are extremely rare in liquor store sales. All business valuation multiples. What are liquor store multiples? In the United States, most small businesses will sell approximately 2 to 3 multiple of SDE. Depending on a number of factors, some businesses will sell for more and some for less. According to the Business Reference Guide, Business Broker Press 2020 edition, liquor stores multiples will range between 2 to 4 times earnings plus inventory. Liquor stores with revenue under 1 million will be at the lower end of the liquor store multiples. Average liquor store profits are 3.5% of revenue. A liquor store with payroll of 7% of revenue, lease cost of 3 to 7%, and gross profit of 25% plus is highly marketable. Liquor stores with profit margins of 30% or higher, with volume sales over 1 million, are very desirable and will sell for a higher multiple. Long-term liquor stores that are well located, highly profitable, strong vendor relations, higher than average inventory turns, strong security system, stable staff, long-term lease, updated physical assets, and a full liquor license will sell for higher multiples. In situations where there is a high grossing stores in proven locations, that is very hard to replicate. Additional factors that influence multiples is whether there is ample parking. Heavy local competition is a negative factor, as is high crime rate. Good liquor store businesses are always in high demand. As we have seen with the pandemic, liquor store businesses fare well even in crisis. During the initial phase 1 of COVID-19, liquor store sales skyrocketed by 25%. Sales have continued to remain strong since. Good liquor stores are in high demand, often with more buyers than sellers, particularly for those long-term liquor stores with computerized systems that have been consistently profitable. Our Mission Peak brokers can help you with liquor store valuations. Should you need assistance valuing a liquor store for sale or purchase, contact Mission Peak brokers. We have performed hundreds of liquor store valuations. We know the ins and outs of what makes liquor store valuable, the appropriate multiples, and how to work with all the parties to get on the same page. Thank you. For more information, click on the link below on the article that we wrote about valuing a liquor store business. Thanks so much for watching. To learn more, click on any of the videos around me. Please like and comment below. Let us know if there is a business sales topic that you would like us to present in the future. Make sure you subscribe to our channel to stay up to date on California business sales. Thanks again.